Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide you in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at how Boeing's 737 MAX crisis is weighing on deliveries.
Plus, we'll talk about how many countries are building their own killer technology based on Iranian designs.
But first, we dive into big tech and Apple. We heard that Apple assembled $14 billion of iPhones in India for the last fiscal year, doubling its production.
It's a sign that Apple is accelerating a push to diversify beyond China. So for more, we were joined by Anurag Rana, Bloomberg Intelligence Technology Analyst, and we asked Anurag why Apple has been cutting its reliance on China.
One of the things we have seen that over the last 2.5, 3 years, Apple has been assembling its phone outside. And, for us, the real reason for that is a couple of years ago, there was a COVID big issue in China. It had an impact on some of the phones coming out that had an impact on sales and so forth. Now, having said that, that was one reason. Second, Apple, prior to the, you could say the COVID issue, was completely dependent on China for all the assembly and their parts. Now, what we are seeing is they are moving out of the assembly from China into other areas, mostly India. But one of the things I tell everybody at the same time, they still make most of the parts. So it's, if we ever get into a problem with China in terms of geopolitical issues, we still need those parts to assemble the phone. It's not as if, those parts are available all over the world.
Anurag, I just wonder how, investors in Apple view this China risk. Are they of the opinion, I assume that if they own stock in the company, they have some level of comfort with the China risk here. Do they just believe it's, hey, it's kind of a mutually beneficial relationship, Apple and China, that at the end of the day, that's what's going to keep everything moving?
Well, I've seen two different buckets. One is people are extremely concerned about the U.S.-China relationship in the long run. They obviously have, they don't want to deal with Apple or any other companies that, fall into that bucket. But the other said, listen, this is part and parcel of the global world chain, supply chains, and most manufacturing companies are dependent on China, like it or not. They seem to be okay with it. From our side, yes, absolutely the biggest risk that Apple faces from a stock point of view, from a revenue point of view, from a supply chain point of view, is if something happens between the U.S. and China. And we've talked about that quite a bit. But from a sales point of view, I think it is, to me, that's a bigger issue right now in the medium term, because China accounts for 18 to 20% of total of Apple's sale. And frankly speaking, that is the big growth engine. And we have seen over the last 12 months problems in that growth engine because of Huawei.
How much do they make these phones for in India versus China versus other areas? I'm trying to get a sense of where the margins are and what they look like.
That's a very good question. And frankly speaking, we thought when they started making more phones in India, or we started see new phones coming out of that would have an impact on their gross margins. But they have managed it very well. And remember one of these things, it's the factories that they outsource their stuff to. And, it's kind of somebody else's headache. But in the end, Apple will have to make some, you could say, concessions. But at the same time, so far, we have not seen any impact on Apple's gross margins. I mean, surprisingly, we have seen them, hold up very nicely over the last 2 years.
Can you just kind of characterize the competitive landscape for Apple in China vis-a-vis Huawei and other phones here? Are they maintaining share, losing share, gaining share? How's Apple doing?
So Apple has not done the same number of sales as Huawei over the last 12 months. Now, there are two elements of it. One is the competitive landscape. People are choosing Chinese phones over a foreign brand. So that's one aspect. The second aspect, which I'm hoping is probably, correct in the long run for Apple's sake, is that Huawei didn't have a very, brand new phone for several years. And this is their first big new refresh, which is why people who have been using Huawei phones in the past are going out and refreshing their phone at a much faster clip. So that could be the second reason. Apple doesn't have that same, I would say, the cachet is still there, but typically what I would do is if I have an Apple phone, I'm doing everything on it, chat and the pictures. But in China, what happens is you do a whole lot of your transactions using the apps that you have or the super apps. And for that, you can download those apps in any ecosystem. So I would say on a comparative basis, you are less prone to be an Apple customer than you are in the Western world.
Well, that's interesting. So then to that point, is that what the regulation or the penalties in the EU and the US is going to force Apple to do in essence? So it won't become that ecosystem in the same way?
Well, there is no super app in the US that is very much like WeChat. I mean, you could say WhatsApp could be one of them, but frankly speaking, Apple's done such a good job of, I would say maintaining their customer base in the US and in Europe that I don't see that happening, that suddenly a new app comes in and people start using that over what's going on with Apple or the habits that they have right now.
So what's the next catalyst now for Apple? What are you looking at? Well, any catalyst, I guess, would be a better way of
asking. June.
Asking.
It's June's Worldwide Developers Conference where they are supposed to talk about AI and what's Apple's AI strategy. That is the only thing that can actually put some fire in this, because other than that, we don't see China bouncing back this year. We don't see any major new product announcement, and obviously Apple Vision Pro is not going to drive the overall growth rate of the company. So it's the iPhone, and if there is anything that's out there that can force Paul to go out and buy a new phone, I think that's going to drive the next cycle.
Our thanks to Anurag Rana, Bloomberg Intelligence Technology Analyst.
We next look at the Bloomberg Big Take story titled Iran's Better Stealthier Drones Are Remaking Global Warfare. It's about how countries from Central Asia to South America are building their own killer technology based on Iranian designs, and the tech often has U.S. components.
For more, we were joined by the story's co-author, Sheridan Prasso. She's a Bloomberg News senior investigations writer. We first asked Sheridan what she learned from her investigation process.
We took a look at how U.S. technology flows are going into Iran's drone program, and what we found is just an incredible proliferation of Iranian drones now spreading throughout the world in ways that surprised even me from when I first started looking into this. We obviously know about Iran's drone proliferation in the Middle East context, right, through Syria, Iraq, including now into Yemen, and then in the Middle East, conflict in Gaza now as well. We're seeing kind of use of Iranian drones in the periphery of that conflict as well. But what also was surprising to us, we found, is that Iranian drones are now being manufactured in Russia. There's a program for 6,000 Iranian drones there that are starting to turn up now in the battlefields of Ukraine. They're increasing proliferation in places like Central Asia and in South America as well. So it really is quite an enormous spread around the world.
How is the technology, how advanced is the technology? Is this a model airplane with a lawnmower engine on the back, or are they going something further?
It essentially is, and really it's fairly low tech, but what's been really successful about these programs is that they're increasingly developing them and learning from experiences on the battlefield, for example, in Ukraine. So what is now believed to be the case is that Iran learned from the way that Iranian drones were now being able to get into Ukraine, had increased their effectiveness in the Middle East context. So it's increasingly battlefield experience and more use of these drones that are allowing them to make more deadly strikes, actually, in these conflicts where we're seeing them, especially in the Red Sea. And also there was the particular case of the 3 servicemen who were killed in Jordan earlier this year. It was a fairly low-tech, small drone, but what it was able to do is, we learned in the course of this reporting, that it was kind of drafting in behind a U.S. drone that was attempting to land at the same time. And those drafting techniques are something that they've been working on improving in the Russian and Ukrainian context. So this kind of learning, growing, proliferating, using low-tech technology, but actually improving its effectiveness is actually proving very deadly.
What can we do about this?
So the U.S. has export controls where we try to stop U.S. technology from going into these drones and into the manufacturing of these drones. The issue, though, is that Iran in particular has become a master of circumventing, over 40 years of sanctions. There are very developed networks where front companies from all over the world are able to acquire this low-tech technology. A lot of our export controls are aimed at stopping sort of the higher-end, chips now going to China, for example, for their AI. But in fact, the proliferation of kind of lower tech, you need like maybe a few hundred low-tech chips, the kind that go into your, lawnmower or your blender, any kind of regular household equipment. That low-tech stuff is actually what's powering the drones as well. And a lot of that is just available. It's recycled from old products. It's available from suppliers in Asia. China, in particular, has not been willing to enforce our U.S. export controls against Russia, for example. So there's actually a very big loophole, particularly in Asia, for U.S. tech flowing now into Russia, into Iran's drone program in Russia. So there are a bunch of concerted efforts now to try to make that stop.
Sheridan, do we know how effective these drones are?
So they've been very deadly in particular instances. What we've seen is a halt to, I forget the percentage, maybe more than 50% of shipping in the Red Sea has been halted by some drone attacks in the past few months. We saw the deadly attack in Lebanon and several other very effective drone strikes as well. And so it's really cause for alarm in Washington. We're wondering how far this is going to go, how effective our efforts at stopping it are going to be. We're considering kind of how do you actually get U.S. companies to stop allowing their technology to go there. And the companies that we talk to, for example, Texas Instruments, Analog Devices, a lot of their stuff, at least 80% of the drones that are turning up in Ukraine are containing this U.S. technology from, in particular, these companies and a few others as well. How do you get that to stop and therefore decrease Iran's ability to proliferate? And that's the biggest question right now.
What did those companies say?
The companies say that we abide by U.S. export controls. We have insist that our suppliers do so as well. The issue is that there's so many loopholes, and in particular, Hong Kong is proving to be a very difficult place. It used to be maybe 10, 12, 15 years ago. We had much better relations with Hong Kong. They would have been a lot closer to Western interests, and now with the changes that have happened in Hong Kong in the last 3-4 years, we have seen less willingness on the part of Hong Kong officials to actually enforce U.S. export controls, particularly going towards Russia. And so we've seen a big uptick in proliferation from equipment going via Hong Kong into Russia, for example. It is much better, though, at enforcing UN sanctions against Iran, and so it has successfully stopped a lot of technology going to Iran, but still there are quite a few kind of leaks in the dam, basically, so it's happening all around.
Our thanks to Sheridan Prasso, Bloomberg News Senior Investigations Writer.
Coming up, we're going to break down why Boeing's 737 MAX crisis is weighing on deliveries.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to the aerospace industry and Boeing. This week, Boeing logged the lowest deliveries in the first quarter since mid-2021, and it shows just how far the plane maker has to go on its road to recovery from a near-catastrophic accident early in January.
For more, we were joined by George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. We first asked George what the latest quarter means in terms of deliveries for Boeing going forward.
For the year, I think this is going to be the bottom. So I'd expect this was the worst quarter. The FAA was in there doing their review of Boeing's manufacturing. Boeing's got to come up for a plan for the FAA. I imagine that takes some hands as well. And manufacturing probably isn't moving very fast while they're in the middle of this process of figuring out how to stabilize the production of the airplanes. And so I think for the year, this will be the worst quarter, and I would expect that things would get better second, third, and fourth into the end of the year.
There's a couple ways to break it down, so let's just take it maybe piece by piece. First of all, supply chain stuff that Boeing will be a part of and Airbus will be a part of too. How are the supply chain impacting their deliveries?
Well, I mean, right now, I think the biggest problem is up at Boeing and not in the supply chain.
So supply chain stuff is fixed?
No, not at all.
Okay.
So I meant for the number of deliveries we've seen this quarter and the constriction in that number of deliveries, this is all Boeing issue, right? This is all Boeing's FAA review, their manufacturing review. Their supply chain, I think, is producing at a higher rate than they are right now. So Spirit Aerosystems would be an important part of their supply chain. They're building somewhere around 38, or they were building around 38 737 MAXs a month when we heard from them at the end of the year, for their 4Q earnings call. We understand from Spirit that their suppliers were even building at higher rates than them in some cases, maybe even up at sort of 42 numbers. And they're already thinking about Spirit moving to a 42 number for the MAX. Again, we're talking MAX, which is the highest volume airplane. They were talking about Spirit moving to a 42 number just prior to the Alaska door panel incident. And that's when everything sort of hit the skids. But I think most of it hit the skids up at Boeing, which has to manage all the FAA, inquiries and their manufacturing review.
George, if I guess if I'm in the company, I don't want to go too fast. I think I can't have any more mishaps here. So it's almost like if I'm an investor, I'm not sure I'm knocking on the door saying, hey, you guys got to get back to 38 or 40. Kind of do it when you can kind of thing.
Yeah, I mean, do it when you can. But, in the long-term interest of Boeing, they have to increase build rates here. And that's going to drive better cash flow and better profits.
That's okay.
I mean, look, their competitor across the Atlantic, right, which has final assembly facilities all around the world, including one in Mobile, Alabama. So
really? Airbus has a thing in Mobile?
Absolutely.
Wow.
Absolutely.
I didn't know that.
But their competitor is operating up in the 45 range per month for their A320, the major competitor. If Boeing wants to be in this business long term, they have to stabilize production, you're right, but they've got to stabilize it at much higher levels. Prior to the pandemic, they were going close to 60 a month for the 737 MAX. It can be done. Their job is to make sure it happens.
So what's the timeline here? When do you think, like year end, where would you like to see them?
So year end, what we've modeled at Bloomberg Intelligence is we think Boeing will be building 38 737s a month by 4Q, which should have been where they started this year out at 38. We think they were looking to break to 42 by the end of the year.
So do we ever get back to the 60? Should they ever get back to the 60?
Well, I mean, if you look at their competitor says they're shooting for 75 a month on the A320. So if their competitor is breaking to those kind of rates, when you break to higher rates on your primary narrow body, you have the opportunity to go out to your customers and non-customers, people that might be upset at Boeing, and sell more airplanes, right? Mm-hmm. So right now what we're seeing is, United has expressed an interest in A321s. Airbus is sort of constricted. Again, they've got, the backlog is full. There's airlines that want all those deliveries for the next number of years. We've seen JetBlue pop up and Spirit Airlines pop up and say, hey, we might be willing to give up some of our airplanes. We think that's a function of Airbus going out to those customers saying, we have another potential customer that would like A321s. Do you definitely want everything you've got in the books for the next couple of years?
This might be a very silly question, but how did we get to the point where we got two airplane makers? And how does that make sense?
This is not volume like automobiles, right? You sell, right? I mean, a good year in this business is a little bit over 1,000 airplanes a year, right? So it's not necessarily an industry that would support 5 or 6 manufacturers with the right pricing and and the right margins, and then you've got to put money into R&D and into development while you're so you've got to earn a decent return so you can invest for the future. We did have more right in the U.S. We had Boeing, we had McDonnell Douglas, Lockheed used to build a commercial aircraft, but I think over time it slimmed down to where you could make them profitable. And at the same time, Airbus was growing in Europe because the Europeans wanted to be in this business, right? This is a good margin, strong manufacturing kind of industry, which really supports great jobs. They were rising, and that meant some of the U.S. manufacturers had to go away to create room for a European competitor. And what we have in the horizon someday, I think it's probably 5 or 6 years away at least, is the Chinese that want to be in the business. So either the pie has to grow even maybe 50% larger, or someone's got to dwindle in that whole thing, right?
Our thanks to George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. On Bloomberg Intelligence Radio, we bring you all of the top analysts providing in-depth research and data on 2,000 companies and 130 industries.
We also have something here at Bloomberg called Bloomberg New Energy Finance, and the idea behind it is to provide data on commodities, power, transport, industries, buildings, agriculture, and new tech, you name it. Now this week, we looked into the topic of electric vehicle charging and how EV charging companies have struggled to make a profit.
We talked with Ryan Fisher, Bloomberg BNEF EV charging team leader. We first asked Ryan who the big players are in EV charging.
Yeah, so some of them maybe not quite household names yet, but you've got ChargePoint in the US, certainly people may have heard of. And the sentiment was pretty positive a few years ago. Stock prices up, and then everything has kind of crashed down. Sentiment not so great. And some of these companies have not met the targets that they might have done. But what we're starting to see is a few companies that you definitely won't have heard of actually have started to post some positive profit margins. So there's like fast charger manufacturers in Europe called Kempower, making the kind of units that can send big power to EVs and charge it fast. And then you've got some of the ones who do the slower power units as well. And then also you've got a couple of these companies that you may have heard of, like ABB, producing chargers as part of a portfolio. So they're selling transformers, and they're sort of using that as somewhat of a way to get into companies and sell some of their other products that they've got and add it on as an additional. So lots going on the hardware side. And then you've got operators. So these are like the companies who basically will sell the electricity to charge a vehicle. You kind of think of it like filling up with petrol. And none of those so far are profitable, but we have seen some good signs. So some of those being EBITDA positive now. Fastned posted that, which is a Dutch one the other day. In the US, none profitable so far, but there's a company called EVgo. You may have heard of, who has these fast chargers. And they actually basically delivered 191% more energy in 2023 than they had in 2022. So good progress there.
So Ryan, where are we kind of, I guess, on a timeline of kind of getting enough charging capabilities into the system that can really support, a wide adoption of EVs? It feels like we've hit a speed bump here. What's the timeline, do you think, when you talk to folks in the industry?
Yeah, it's an interesting one because we cover the global market. So you look at China, and they installed about 1 million of these public chargers last year, and the US did sort of low tens of thousands. So there's a big difference depending on where you are in the world. I think the US and Europe are more similar in how they'll play out, and Europe is maybe just 5 years ahead. So Europe has got actually loads of competition at the moment, and the story a little bit when we look at this is some of the companies looking like competition is starting to weigh on the demand that they're delivering because it's a bit monopolistic. So I want the best land as a company, and I want the best grid connection, and I want that to be somewhere that people are going and somewhere where people can buy things. And they're realizing that, well, the demand isn't quite there yet, but if we believe in the long-term trajectory of EVs, let's get in this business, let's get those spots. So we've seen that in Europe, and I think the US is just starting to tick over. The US has been hugely dominated by Tesla. So if you look at Tesla on the vehicle side, kind of 80% of these pure battery electric vehicles 5 years ago, kind of Teslas. And then they also provide the supercharging, and that's kind of pushed all the competition out. But what we saw last year was some of these other automakers really producing the EVs and therefore providing a market for other people to come into.
This is a super dumb question. Where does a charging operator get the power to then enable me to put a Tesla into that network?
There has been a lot of these companies that are going out and they're saying, do you know what? Instead of putting 2 chargers in at my petrol station where the power exists, I actually now need kind of 12 chargers. And in some cases, when you look at, for example, the Tesla stations, they've got like 100 chargers in one spot. Now that becomes a big grid connection. The next thing is charging the trucks. So this could be like the same amount of power as a town. And a lot of the utilities are taking too long to do it. So it's like, how long does it take to get a permit? How long does it take to actually get energized? Can you make the agreements with the land leaser? All of this has kind of slowed it down. But clearly, industry's trying to work together, and this has become a big topic for the automakers and the utilities as well. Some of them trying to sign contracts on site. So if you imagine these companies, small fry, like several small meters across multiple places, the utilities maybe not so interested in that. But now they're actually delivering a lot of demand. So as I say, looking to other markets in the US and China being a good example, the public chargers in China now deliver more energy than the whole of Ireland. So lots of energy. And therefore, that becomes interesting because if you're an energy developer and you're doing like solar on site next to it with a battery, and we've seen Watt EV, which is one of these truck charging companies, basically build a station that's not connected to the grid at all. It's just got straight to the solar and a battery. So cool innovations going on there.
Hey, Ryan, here in the U.S., EV sales have slowed materially, and a lot of people are trying to think there's a combination of reasons, price being a big one. But one of those drivers is the lack of a fully ubiquitous charging infrastructure. When you talk to your EV companies, how do they think about it? Are they concerned about the long-term demand of EVs in general? And if so, do they feel like they can be part of the solution there?
Yeah, and there's definitely kind of differences in opinions. The US Hyundai CEO saying something along the lines of today, why buy an EV from an automaker who's lobbying against EVs? And obviously he's talking about the US there, but you do see a difference in those that are kind of in on it and those that aren't. And I think some who aren't have previously been so. They've committed billions, they've talked about targets, and then they're starting to row it back. And some of that is maybe because the technology is behind, they can't do it as cheap as everyone else. So there's different reasons. And I think when you look at liabilities, I don't think that's talked about enough, actually. Some of these companies have put cars out there, and then the batteries had a problem, and they've got to recall it, and that could be multi-billions. So I think there's some caution as well in saying, why don't we put a few less cars out, because then we can learn from them and we can do it later. Some of the narrative has been they're not putting the cars out because quite feasibly the battery operations are not up and running, but I think there is other reasons.
Our thanks to Ryan Fisher, Bloomberg BNEF EV charging team leader.
All right, coming up on the program, we're going to break down how beer sales did last quarter at Constellation Brands.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move now to the beverage companies, Constellation Brands. So the company reported fourth quarter earnings per share that beat analyst expectations, and this was the result of better than expected beer segment sales and a wider operating margin.
For more, we were joined by Kenneth Shea, Bloomberg Intelligence Senior Consumer Products Analyst. We first asked Ken for his take on the company's earnings.
So the quarter, I think the backdrop, first of all, was for a slow quarter, for most wine and beer companies right now and spirits. Given some recent results from Brown-Forman and Duckhorn Portfolio, they're a producer of wines, where they're all saying, trade inventory reductions stemming from cooling demand across all alcoholic beverages was kind of the backdrop to this earnings report. So when it came out, it beat expectations. Beer sales were up 11%. Wine and spirits were weak, but again, this is mostly a beer company. And so that's why it was perceived very positively, because this was a dose of good news, an otherwise very cautious market. So the company's doing basically what it said it would do. It had good results for beer. It reduced debt some more. It's committed to expanding its big brewery operations down in Mexico, increased the dividend 13%. So from a shareholder point of view, they're doing the things they said they would do, and the beer results beat expectations, and that gave the market a dose of good news.
What's Constellation saying about the consumer in general? Because there's a lot of concern out there as we look at some of the big data coming out of Washington, D.C. about the consumers, inflation, and all that type of stuff. What are they seeing?
They look at the paper also. They understand, the environment that they're in, that the consumer has definitely turned a little cautious here towards purchases that they can defer. I guess that's the best way to put it. Beer is, a relatively low price point product vis-a-vis wine and spirits, a high-end bottle of wine or high-end bottle of bourbon. You can maybe put off for a while, but, a bottle of beer or even a six-pack, whatever, you're not as prone to do that. Even though Corona and Modelo, command a very premium price, it's a premium product. So they're aware that they can't just keep, tacking on big price increases. They're aware of what's going on. But they see the consumer is resilient, particularly for beer right now.
So, Ken, when we get you on, we like to talk about all the things. And one of the things we like to talk about is weed, because you walk down the street in New York City, you get the wafting I mean, I think it smells good.
Right. Let's clarify this, that Ken covers the cannabis stocks as well.
Yes.
It's not that he is
maybe does the
connoisseur of the weed.
Right.
He's not our
You're right.
distributor.
I did not frame this correctly. Ken, you're an analyst that also covers the cannabis stocks. When I walk around in New York City, I smell a lot of cannabis products. How are these companies actually doing?
Well, Alex, they're doing pretty well from a sales point of view, from an EBITDA point of view. But you know, the taxation on cannabis companies is so onerous that not very many are profitable from a GAAP accounting point of view. If you're an investor in this market, you certainly have to be patient. And that's because you need some help from regulators from Washington, whether it's a reclassification from a prohibited drug like marijuana is considered today, or it's outright legalization in some states and so on. So you need some help from regulators to keep this thing going. So it's going at a sales are, from an industry point of view, are moving positively as more states legalize. Florida, it's going to be on the ballot. Florida could be a $6 billion legal market, or about 3 times the size that it is now, in a very short order, if in November voters approve legalization for adult use in November. So it's moving positively, but again, from an accounting point of view, it's not looking as rosy.
Our thanks to Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst. Also this week, we were joined by Jason Kelly, Chief Correspondent for Bloomberg Originals, and former baseball star Alex Rodriguez. They host a new podcast on Bloomberg called The Deal with Alex Rodriguez and Jason Kelly. In our interview, Jason and Alex discussed how sports are consumed live, the state of New York Yankees, and playing in New York, and what is happening in the ranks of college sports. But first, we asked Jason about some of the deal-making in sports that really stands out.
Dial made some money on the Phoenix Suns when they were sold for $4 billion a couple years ago. So that's been one exit. I mean, what's interesting is, so 6th Street, just speaking specifically about 6th Street, and, this is started by Alan Waxman, former special situations head for Goldman Sachs, was in a partnership with TPG. So they've invested $125 million. They led an investment for $125 million into Bay FC. That's real money. Paid a record franchise fee, $53 million just to buy the team. They're looking at a scenario where they can get a 5x, 10x. This is a long hold. So the franchise values, as Alex just demonstrated, think about, Jerry Jones bought the Dallas Cowboys for less than $200 million in the late 80s, early 90s, which, by the way, they said he was insane. That was a crazy amount. This is a franchise now worth $9 or $10 billion.
Alex, let's talk about ownership. You're part of an ownership group for the Minnesota Timberwolves, right? Talk to us about that experience, and I'd love for you to talk to you about, my personal opinion is, I'm concerned about the valuation of franchises. I'm concerned about salaries because it's all predicated, in large part, on broadcast rights. Yeah. And with cord cutting, I'm not sure ESPN's going to continue to write these crazy checks. So talk to us about kind of what you've learned about as being an owner there.
It's funny because one of my good friends and mentors is Magic Johnson. And of course, he played basketball for a long time, and he owns a baseball team. Yep. And I played baseball for a long time, and I'm part of the ownership group of the Minnesota Timberwolves and the Lynx. What I think is there's no question that the giant in sports in America is the NFL, right? And to think that almost 20 million people watch Caitlin Clark. Those are NFL numbers on Sundays. That's the number one driver for all sports, and which creates a lot of people to be very bullish in women's sports. But going back to we have the Lynx as well. But I do think that the NFL and the NBA are global sports, especially the NBA. It's growing year over year. If you look at social media as an example, as a metrics, we're almost 10-1 to the NFL. We're almost 15-1 to Major League Baseball. So LeBron James, Michael Jordan, Steph Curry, these are global names. I think that is going to be a different landscape, but you'll have more contributors. Maybe you have NBC pop in, Amazon, Apple. There's a lot of suitors. It's not going to be the traditional. So ESPN may not write its biggest check, but is there? I'm not speaking for the NBA. I'm just giving you my opinion. That you may have a world where NBC may split the finals with ESPN and ABC. So I think you'll get to a similar result, just a different way.
So you said those words, and I knew those people. So I feel like I'm not qualified to ask this question. But then for someone like me, who's a newbie who maybe wants to watch some stuff, I don't know. I need a spreadsheet to find out what's playing where, when, what time, Amazon Prime, Netflix, something like that. And I wonder if that's going to be a hurdle Jason, what do you think to like?
I mean, it could be. I mean, and Paul knows this space better than anyone. There's been sort of a fracturing, but now sort of a reconsolidation, it feels like, of how we're going to consume sports. I mean, you've followed this for years. You know that live sports, Alex knows it from being on television and being broadcast himself. People love live sports, and that it's one of the only things that actually keeps people coming back to live content. I do think, though, we are in this weird world where sometimes you don't know where to find it, and yet when you do, it attracts the eyeballs.
My New York Yankees off to a great start this year.
Yes.
What's your scouting
You could
report?
say our New York Yankees
I don't know.
in this room.
Yes.
Off to a great start this year. And what's your scouting report of them?
Well, I think the Yankees have done a bunch of good things this year. Excuse me. One of them is they've introduced baseball people back. If you think about the powerhouse of the Yankees, they've been built by great baseball people like Gene Michaels, Stick Michael, as they call him. Lou Piniella, Billy Martin. They've gone away from that the last 4 or 5 years, and they've suffered tremendously. The fact they brought baseball people back in, they brought a much more balanced lineup, meaning, Alex, there's more lefties than righties. Historically, Yankee Stadium is better for lefties.
Really?
Last year, they had like 9 righties in the lineup, which is way too much. They've gone back to a much balanced lineup, and now they have the best 1-2 punch in the sport with Aaron Judge and Juan Soto. The challenge is, do they have enough pitching, is one. And two, have they cornered themselves by bringing in Juan Soto and not have a long-term contract?
Right.
When now, is he going to want the Ohtani contract for $700 million? And is he just a one-year wonder here in New York? I think he's going to have a massive year. The question is, can they keep him? Second question is, do they have enough pitching to win the title?
Well, let me ask you that question. We like to think, New York fans, that New York is a selling point. Everybody would love to be. If you can be a star here, you can be a star anywhere. And there's nothing better to be a star than New York City. A lot of players, I think they find it hard to play in New York. What was your experience coming to New York? I know you're a New Yorker, so you kind of know this, but some of the people you saw during your career.
No, Paul, you're exactly right. I mean, some people, the kitchen's maybe a little bit too hot for some players, and you know right away if they're uncomfortable. It's a different place. It's the biggest media market in the world. As they say, the pinstripes are very, very heavy, and not everyone can carry them. Juan Soto is obviously one that is going to play really well. Aaron Judge, the Jeters of the world, they're icons for life because they won here in New York. But some, I mean, they melt into the sun. I mean, you've seen a couple over the last 4 or 5 years that were a shell of themselves, and you quickly have to pivot and get them out of here.
So this is really cool. Like, what you guys do is super fun. Jason comes in and he talks about it. You can tell he's like totally digging this. What's it like to work with Jason Kelly? How do you manage that guy? Like, what is
the ego,
that?
the diva?
Alex, we already made a deal because we are, he's covered private equity. He's a great writer. So I say he writes and I use the bat. So I hit, he writes, and we make a good team. But no, Alex, in all seriousness, is really the intersection of Jason's career, mostly here at Bloomberg, and my career, mostly with the Yankees. And the fact is, what we're talking about is exactly both. And we live in a world where it used to be sports and media and culture. Now all three have come together. And that's what we try to take away. And then also a lot of lessons learned in this world of Shark Tank, where young people want to be more entrepreneurs than athletes. Right? And that's, I think we're serving up and teaching and hoping, inspiring through storytelling a lot of great
And I like
lessons.
what you guys do, kind of bringing sports, entertainment, all that together. And we're seeing it actually now in college sports with the NIL, the transfer portals. A lot of these kids are able to monetize their value.
Totally.
But there's some downside to that, it seems like. If you talk to, Coach Jay Wright at Villanova or some others, they're saying, boy, I'm not sure, maybe we've gone too far. What do you think, Alex, about what's happening in the college ranks about paying some of these athletes?
It's a very dangerous road. It's a very dangerous and very slippery. And the reason why I love that players are getting, the finances and all of that, but maybe there's a structure where there's more parity. Maybe there's a structure where kids don't get the money when they're not ready for it, and they get in trouble by not knowing how to pay taxes. And is this more of a liability than an asset? I'm all for somebody getting market value, but is there a world that we can, hold until they're 30 or 35 until they get the majority of that, where that money's compounding for them? So gift and the curse. And the other part is that I'm concerned is we want to teach. Coach K is one of my great friends and one of the great personalities in all of sports. You want athletes to be around Coach K for 3 or 4 years, not just one.
Great point.
So, and same thing with Calipari and all of that. So we want to teach these kids that, the power of restriction and to be able to wait a little bit before they get, the marshmallow, as they say.
Our thanks to former baseball star Alex Rodriguez and Jason Kelly, chief correspondent for Bloomberg Originals and executive producer of The Deal with Alex Rodriguez and Jason Kelly.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.